In this video, we're going to take a look at choppy markets and how to deal with them, really. So a choppy market is something that you should be very comfortable with because, quite frankly, it's the norm. 80% of the time, 75% depending on the instrument, markets are doing this as opposed to this. Now, you notice I'm on a 5-minute chart, so I'll go ahead and zoom out. This is more of a day trading thing, but it can apply to longer term charts as well. But a day trader is, by their very nature, going to be hyperactive as far as trades are concerned. So there are a couple of indicators that you could use to perhaps help. One would be the stochastic oscillator. And this indicator measures when something's overbought or oversold. Ultimately, you want to define where support and resistance may be and simply trade back and forth. However, one thing that I would point out is that you almost always have a prevailing trend ahead of time. Most of the time, the expression is consolidation leads to continuation. So the way that I deal with this is I will take a stochastic oscillator, once we start forming, and there should have been support there. There was a gap. Once we get this stochastic cross, the moving averages cross underneath, in this case, the 20, which is the oversold, you're looking to buy. And once you get into overbought and cross, which is above 80, you're looking to sell. Now, here's the thing. The longer term trend, in this case, was up. So you're going to have much more luck buying. So how do you manage that? Well, if you really must trade in both directions, and quite frankly, I don't recommend it. I recommend just looking for support and going with the longer term trend because eventually you break out of this. But leaving that alone, if you feel that you ultimately must do this, a simple trick that I have used for money management has helped me over the longer term. So I take the stochastic oscillator, I use that as a signal on with trend trades. I risk a whole unit. So whatever that is, let's just say I risk 1% of my account. Not with trend. I'll just put not with or NWT here. I'll risk 0.5%. So what happens? This gives us the opportunity to perhaps walk out of here with a little bit more clarity. You can see that we bought here, we hit resistance, got oversold. So at that point, you've got a 1% trade that worked out. But watch what happens. Your 0.5% goes against you. So, now you're down to only a half a unit of profit. And it's actually not even quite that. It's more like 45%. You get an oversold condition just above support. And you could have closed out there for an entire move. So then you're at 1.5 trades, units, if you will. So you've made money by going with the trend. Had you shorted here, not ahead of the resistance, that would have been a loser and you'd be covering your trade. Couple rules are this. If you get, the thing about trading choppy markets like this, if it proves you wrong, so for example, you shorted right here and it gapped up there, get out. You absolutely must get out because a lot of times these can lead to much bigger moves, as you see here. So let's go ahead and take a look at letter X here on the day and see if we can identify something similar. So the daily chart, same thing. We're just kind of chopping around here. We kind of begin to form a little bit of an area of choppiness. It's consolidation. That's really all it is. You get a sell signal here in the stochastic. You recognize that this is support. You get out there, that's your half because longer term we had been going up. You get a cross here, but not a signal. So you literally only get this entry to the upside as we cross there, and you get your ones. You got 1.5 trades. Now, eventually, you get this cross that's in the middle, like I said, and that's not a valid signal. That's a 50-50 ball. We do break above and we gap higher. Well, now it becomes an entirely different set of circumstances. So you've picked up 1.5 wins while the market was chopping, and then you continue to go further. Let's go ahead and, just for the sake of argument, let's do Walmart and see if we can find a nice choppy time in the market. So you can make an argument for this being a choppy time of the market. But even that is a little suspect because it's more like an arch. So you do need to recognize that basically what you're looking for is something that's definable, because if you can't define the support and the resistance easily, that's not a good sign. Here you had an area where, we had been rising. You had a buy signal here. It hit the resistance. You had another close to a buy signal here, which you could have taken, I suppose, if you used a little artistic license. But you can see we broke out and went to the upside. So you had 1% and then you had a completely different trade. And that'll repeat on and on. So by all means, choppy market strategy, pretty simple. Really comes down to money management. You'll hear a lot of, you can use this indicator and you can use that indicator. I just like using an oscillator that shows overbought or oversold. You can use RSI, but I found the stochastic oscillator tends to work a little better in sideways markets.